The number one complaint we hear from people in retirement is that they thought their taxes would go down when they stopped working. Hi, my name is Greg Parker with Engrave Wealth Partners, and I'm here today to talk about what your advisor isn't telling you about income in retirement. Now, if you've watched any of our other videos, you know that we tend to focus on the three most important things for retirement. Number one, we obviously want to focus on how to build a safe retirement investment portfolio that is designed to continue to offer you the growth through the rest of your retirement years, but also manage to get you the income that you need, especially in the early years when you might need a little bit more income. But the third item that we focus on is often overlooked by most other advisors, and that is taxes. Understanding the impact on taxes and how that affects your retirement income is of most importance. When most people start taking retirement income, they don't give much thought as to the tax efficiency of that income. Where does the income come from? And how can we generate a retirement income stream for you that is more tax efficient and leads to lower overall taxes? Well, let's start by taking a quick review of what retirement looks like at the very beginning so that you can understand better the choices you need to make in retirement and in terms of getting a tax efficient income. So starting off, for most people, you have access to 3, maybe 4 different types of retirement savings vehicles while you're working. That may be a pension, which is received either as an annuity or a lump sum in retirement, a 401k savings plan, restricted stock units or RSUs, and perhaps even a supplemental pension plan. What's important to understand is that retirement, most of these vehicles will change by nature. In fact, mapping out what happens to everything, you'll find that the majority of your retirement savings will end up in 2 or 3 different types of savings vehicles. The pension, as I mentioned, generally comes in 2 forms. If it's received as an annuity, that is typically sent to your bank account via wire and is treated as ordinary income. You're going to hear me use that word a number of times in this video, and it's important to understand ordinary income is an IRS term. The IRS defines ordinary income the same as salary or wages. It's the type of income that applies to the marginal bracket system. The more you make, the more taxes you'll pay. The annuity payment coming from most corporate pensions is treated as ordinary income. However, you can also choose to take the lump sum option from your pension, which will avoid the ordinary income treatment because you're allowed to roll the lump sum payment directly into an IRA rollover. This IRA rollover is a personal IRA. It's in your name, and it's held at any financial institution that can handle IRAs, such as a brokerage firm or bank. The 401k savings plan is treated very similar. It can either be rolled over directly into an IRA rollover, or if you choose to use the NUA stock option, if you're not familiar with NUA or net unrealized appreciation, you can go back and watch some of our retirement basics video series. NUA stock is treated as a tax benefit by allowing you to roll company stock directly from a 401k into an after-tax brokerage, individual or joint brokerage account. Why does that privilege look different? Because the IRS allows you to take low cost basis company stock, roll it out of a 401k, pay taxes only on the original cost basis, and move it into your after-tax individual or joint brokerage account. Many tax benefits to NUA, but for now, understand that NUA stock goes into an after-tax account, an account where the proceeds have already been taxed. Finally, many of you had after-tax contributions in your savings plans at work. Those monies should have been rolled over into a Roth IRA. If not, you're now having to keep track of after-tax money inside of a personal IRA. Folks, that's a nuance you don't want to have to mess with. If possible, please always roll those after-tax contributions into the Roth IRA. Finally, most companies treat restricted stock units and or supplemental pension plans as taxable upon vesting. In other words, when you become eligible to vest in those restricted stock units or supplemental pension, those become taxable at that moment, and the net proceeds after tax withholding normally goes into your after-tax brokerage account. Folks, this map is instrumental in helping you understand where the retirement vehicles go, but it's also helpful in looking at specifically how do we consider retirement income. Now that you're in retirement, the key question is, what is the most efficient means of generating your income, and where should we take it from? The key components you need to understand is that income from each of these different vehicles is treated differently according to the IRS. For example, any income that you take from a personal IRA is treated as ordinary income. There's that term again. Ordinary income, again, the same thing as salary and wages. It's income that is applied to the marginal bracket system. The more you take, the more tax you'll pay. Now, you may say, well, wait a minute, inside my personal IRA, I've invested in some stocks that generate qualified dividends. It doesn't matter. What about long-term capital gains? It doesn't matter. Folks, no matter what you've invested in inside of a personal IRA, any money that is pre-tax, money you've never been taxed on, once you take it out of the IRA, is considered ordinary income. Marginal brackets apply, and you'll pay taxes according to how much you take out. Obviously, it's not the most ideal way to generate a retirement income. Well, what else could we do if we had an after-tax individual or joint brokerage account? Well, there's the opportunity for what we call tax-preferred income. Tax-preferred income, folks, depends upon how the money's invested. Now I go back to inside that brokerage account, you've invested in some stocks that pay qualified dividends. That's helpful. Qualified dividends generally enjoy a lower marginal tax rate. Most of you will max out your qualified dividend tax rate at no more than 15%, even if your marginal brackets are 22 or 24% or higher. Same thing goes with long-term capital gains. Long-term capital gains generally max out at 15%. The only exception for qualified dividends and long-term capital gains is if you're in the absolute highest marginal bracket, your dividends and capital gains generally max out at 20%. Folks, that's important. What about other investment options like municipal bonds? Municipal bonds are bonds issued by local governments and entities within the government that generate tax-free income. Why don't most investors just put all of their retirement savings in municipal bonds and generate tax-free income? Well, because the yields and interest rates on those municipal bonds are generally low and don't provide enough income for most people to live off of. Now, what about the Roth IRA? Remember, the source of the Roth IRA was your after-tax contributions, either in the form of the $6,000 a year you can put into a Roth IRA after tax, or any excess after-tax contributions that came from your savings plan. Because those original contributions were tax-free, the IRS allows you to always take your original contributions out of a Roth tax-free as well. Now, there's also an opportunity with a Roth that you need to know about. The Roth IRA has the potential to also generate tax-free earnings. Folks, tax-free earnings is unheard of. To look at a vehicle that can give you tax-free income on earnings, that's something you need to know about. The problem is you have to qualify to get the tax-free earnings, and the IRS generally has two tests that you must pass in order to get tax-free earnings. Test number one, you must have had the Roth IRA for at least 5 calendar years. The IRS does not track months, they don't track days, they only track years. If you originally opened a Roth IRA back in December of 2015, the 5-year rule starts in 2015, and therefore by 2020, you're eligible to receive tax-free earnings. What if you've never had a Roth IRA before and you decide to start one in 2023? Well, your first moment of passing test number one won't come until 2028. 5 calendar years from the time of opening your original Roth IRA. What if you say, well, I opened one of those Roth IRAs with a little money a long time ago and forgot about it, never put any more money in it? As long as it's been more than 5 years, you qualify for tax-free earnings on any Roth IRA. As long as you have had a Roth IRA for more than 5 calendar years, you meet test number 1. Test number 2, much simpler. You must be over the age of 59 and a half. So at retirement, the key is understanding that if you've never had a Roth IRA before, it's important to get one started. And we'll talk in future videos about other ways to use a Roth IRA for long-term tax planning. But for now, know that the Roth IRA is a tremendous vehicle. It generates the opportunity for tax-free retirement income, but you had to know it ahead of time and have started it prior to retirement to really enjoy any benefits. For most of the retirees we work with, they've not been contributing to a Roth long enough to have a big enough balance to generate all of their tax-free income. One other caveat about a Roth IRA that we really like to talk about. A Roth IRA is not subject to required minimum distributions as a normal IRA is. In that personal IRA rollover, you must begin withdrawing proceeds at age 72 according to the IRS minimum calculations. Those calculations are preset and predetermined, and they are generally more than most people are withdrawing, meaning that you're going to generate extra taxable income. The Roth IRA has no RMD requirements. There's no minimum withdrawals. You can leave money in a Roth IRA all the way up until your death. And when your spouse inherits a Roth IRA, he or she inherits a tax-free investment. Same thing if it goes to the next generation, to the kids. The kids also inherit a tax-free Roth IRA. Very important treatment on a Roth IRA that you may not be familiar with, making it one of the most important retirement planning tools that we use. If you're not familiar with a Roth IRA, please get in touch with us so that we can talk about what those benefits would be for you. So again, where do we take your retirement income from? Back to the way we began. In order to generate the most tax-preferenced retirement income stream, we want to generally start with after-tax investments first. It gives us the opportunity to maintain a much lower tax exposure based on how we've invested the brokerage account. Again, taking advantage of tax-free bonds, qualified dividends, long-term capital gains, all gives us the opportunity to maintain a much lower tax profile in those early years of retirement. If we've exhausted any investment options in the brokerage account, we then want to think about any NUA stock that you might have moved out, which now enjoys qualified dividend treatment. If you took advantage of NUA moving company stock from a savings plan into your after-tax account, you've got the ability to supplement your retirement income using tax-preferenced dividends. That's another good source. Why would IRA distributions be at the absolute bottom of the pyramid? Because they have the least friendly tax impact. When we think about IRA distributions, any amount of money we take out is going to be taxed as ordinary income in the year you receive it. Looking at this strategy, however, many people will look at this and say, hey, the opportunity to keep my tax bracket low in the early years is very good. And you're right about that. But there's something that we also need to acknowledge, and I'm going to open up the door to future videos and things that we want to talk with you about, because when most people think about their retirement income stream, it's very easy for a financial planner to say, we can generate an ever-increasing stream of retirement income for you based on your retirement savings. But what they often overlook is that hidden line down below, which is how much in taxes you'll pay. Now, as you would expect, if you're taking more income each year, it's very likely that you're going to be paying more taxes each year. Again, largely depends on where the income comes from, but it's easy to assume that your tax bill is going to go up as well. But what most people don't recognize is that step up that happens along the way. That step up in the tax bill is the age 72 required minimum distributions we already spoke about. RMDs are going to increase taxes for nearly everyone in retirement, and they had to do nothing in order to do it. It's simply the IRS stepping in at age 72, stating it's time to begin withdrawing more from your 401k or IRA accounts. Looking at that tax problem, if you will, creates some ideas for us that relate to your retirement income. For example, we would like to think about a long-range plan that focuses in on your retirement assets, the income we're going to generate off of those assets, and what the tax impact of that would be. It's important to think about that not only in the early years of retirement, but we need to be thinking about that all the way out to age 95 or beyond, which is most life expectancy tables today for anyone that lives to retirement age. Thinking about that, what we want to do is build out the hypothetical scenario that helps you to see where that income comes from, but most important of all, what the taxes paid off that income will look like. By focusing on that, we are able to step back and do some advanced tax planning in your early years to still provide the income you need, but try to help manage the lower taxes later on after age 72. Folks, if that's something you've never considered, how taxes and retirement income are intertwined, and that inevitable tax problem coming at age 72, you need to watch the next video on our series of what your advisor isn't telling you about taxes in retirement, where we're going to share with you a couple of the ideas we use working with clients to help them know exactly what they can do to minimize the taxes due after age 72. This might look a little different. If you've never seen this before, an advisor that works not only with your investments, your income, but also your taxes, we would invite you to have a conversation with us, because we've noticed the trouble that comes in thinking about retirement without thinking about the taxes. And so we created a commission-free fiduciary planning process. And that process is there to help you minimize the taxes paid in your retirement years. Make sure you get the income that you need, especially in the early years where you might need a little bit more, and how to protect the investment portfolio from significant market downturns. Folks, we answer basic questions like, does my portfolio have too much risk? Or how much am I actually paying in commissions and fees? And what about those Roth conversions I hear about managing my taxes later on? And how about the tax liability I'm expected to see from my RMDs? All very common questions that we entertain and address every day. And we mitigate those questions by performing what we call a retirement optimization plan. This is a plan that's free of charge, and you don't have to be a client of Engrave's to engage in it. We simply start by looking at your existing retirement savings, looking at the tax implications that come from those savings, and understanding from your tax return what sorts of tax issues you might face. We can provide and prepare this plan within 24 to 48 hours of accepting your information. In order to start this process, please head over to our website at engravewealth.com. Click the button that says Start Your Free Retirement Analysis. Again, there's no charge. We will provide this to you via Zoom or meeting in our office, and you'll be able to know exactly what your tax liability is going to look like after age 72, and a few ideas of how you can help mitigate that problem. Folks, thanks for your time on the video today. We appreciate the opportunity to talk about retirement income and taxes. Stay tuned. That next video, what your advisor isn't telling you about taxes in retirement, is available now for you to know exactly what to do about saving tax money in retirement. Thanks for your time today. Have a great week.